Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Financial Management. The course code for this subject is BS 251. This is our lecture number 29. The topic for today's discussion is Account Receivable Management, part 3, under which we'll discuss the impact of cash discounts and firms' collection programs on the overall profitability and cost of the firm. So the basic topic is account receivable management, and we'll address the next two factors, that is the alteration in the collection and credit policies will leads towards either in profitability or in certain cost level. So we have to trade off or match the overall cost bear by change in the cash discount of the credit policy and as well as in the firm's collection programs, and then to compare that cost with the additional profitability of that alteration or change in the credit and collection policies. So basically this lecture is in continuity to the previous two lectures, and we'll continue the same numerical example but with the topic to address the cash discount to be offered to the credit customers and as well as certain firms collection programs. The outline of this lecture is covering our broader topic of account receivable management, under which the company is considering its credit and collection policies, and in specifically under the umbrella of credit and collection policies, the factors to be addressed are cash discount and as well as the firm's collection programs. So our learning outcomes for this lecture will address the firm's credit policy and to understand the trade-off between profitability and cost involved. Secondly, to understand how the level of investment in account receivable is affected with the credit policies, as we are going to offer them cash discount and other collection policies, and how such alteration or changes will impact the investment level in the firm's overall account receivable. Thirdly, we have to critically evaluate the proposed changes in the credit policies. That is, in this specific lecture, we are going to address the cash discount and the credit period alteration. Finally, we'll discuss that certain sources are there which are really helpful to the manufacturing companies which are encountering with the credit applicants to have enough information about the background and behavior of those credit applicants, and on the basis of those information the company will decide either to sanction the credit sales to those applicants or not to sell out product to those customers because they might default in the future. So let's go ahead. We have already covered our quality of trade credit, or we have addressed our credit standards in detail in the previous lecture. We have also covered the length of credit period along with the numerical example and as well as the profitability and cost trade-off involved when we are changing the length of time period. So this lecture will address the third factor, which is possible cash discount to be offered to the credit customers and as well as if we alter the firm's collection program. So let's go ahead directly to the third factor. So we are here to address the credit and collection policies of a firm, typically a manufacturing firm, and to address what if the company is offering the cash discounts to the credit customer for the early payments. So in order to understand this, we have to first of all define certain phenomena and then to take a numerical example to address the cash discount aspect and its impact on the account receivable collection and as well as on bad debt losses. So what is a cash discount period? Let us first narrate it quickly. The period of time during which a cash discount can be taken for early payments. And we'll take an example over here, and let me select the pen. So we can see that certain terms will depict that you are being offered with certain percentage of discount for early payments. For example, 2 by 10 means that the company is offering you 2% discount if the customers are paying in 10 days. Like if, let's suppose, the overall credit period is 30 days and the company is offering you 210 terms of sale, it means that if the customer is going to pay out its obligation to the company within 10 days, then they can earn or they can receive 2% discount on their purchases. So it allows a cash discount in the first 10 days from the invoice date. And what is a cash discount? A percentage reduction in the sales or purchase price allowed for early payments of invoices. Let's suppose a customer from Basket Wonder has purchased $100 of commodity on the basis of 210 and net 30. Net 30 means if they are not going to avail this 2% discount, then at maximum time period given to this company is 30 days. So in this case, if the customer is going to pay out this $100 back to the company of Basket Wonder, as we have selected for our example in this context for discussing the account receivable management. So in this case, if the customer is going to pay out within 10 days, then the Basket Wonder is going to offer them 2% discount to avail. It means that they are required to pay out only $98 against what they have purchased at the invoice price of $100. So for example, 210 allows the customer to take 2% discount during the cash discount period. And this phenomena will be explained shortly with the help of a numerical example in the context of trade-off between profitability and additional cost. So let us take an example of introducing a cash discount. A competing firm of Basket Wonder once again has been selected to elaborate the phenomena, is considering changing the credit period from net 60, which has resulted in 6 account receivable turns per year, to the period of 210 net 30. Now this scenario states that the maximum time period with the credit customers of Basket Wonder company is 60 days. So in this case, the total account receivable turnover will be 6 times in a year. Beside this, the company is offering 210 and net 30 condition, that is, they are offering the cash discount of 2% to all customers if they are going to pay within 10 days. So the purpose of this discount is actually to expedite the account receivables collection within 10 days rather than to wait for 60 days for those account receivable to be collected by Basket Wonder, because they have sold out their product on credit to the credit customers. So in order to expedite this account receivable to be collected in cash, the company is offering 2% discount to all customers, existing plus new, if they are going to pay out their obligation within 10 days to the Basket Wonder in terms of cash. So beside this, the further auxiliary data of this numerical case is stating that the current annual credit sales of the company is 5 million. Expected to be maintained. After offering this discount, the first condition of this numerical illustration states that the annual credit sales will remain intact. Secondly, the firms expect 30% of its credit customers in dollar volume to take the cash discount. So out of these 5 millions of credit customers, only 30% customers are going to pay out their obligation within 10 days and to avail 2% cash discount on early payments. So this is actually the procedure with Basket Wonder or any other company to expedite their account receivable collection, because we know that time value of money phenomena and the early dollar we are going to receive in our company worth more than the dollar we are receiving after 2 days, 10 days or 50 days. So in order to have efficient management of account receivable, the company use different tactics to expedite the collection of account receivable. So under this package, 30% of the credit customer are actually availing this opportunity to earn 2% cash discount. And when they are going to pay out their obligation quickly to the firm within 10 days, it will actually increase the account receivable turnout to 9 times in a year. Let's move ahead. Once again, the before tax opportunity cost, as we are continuing the previous example. So this is why once again the opportunity cost for each dollars of funds tied up in the additional account receivable is 20%. In order to understand this phenomena, you have to listen to my previous 2 lectures where I have explained in detail what does this opportunity cost mean and how we can use the other option to earn 20% return. So we have to compare our current scenario with this earning and then to decide either to go with the cash discount offered to the customer or not to go with them. Finally, the data states that we have to ignore any additional bad debt losses, as this bad debt losses will be covered in the subsequent topic shortly. So we have to ignore bad debt losses in the current scenario that may arise should the competing firm introduce the cash discount. So the question asks us that either the company should offer this cash discount, and is it beneficial to the Basket Wonder to offer cash discount or not. So we have to figure out on the basis of numerical calculation. Therefore, the financial manager normally calculate the profitability and the cost or opportunity cost involved in the scenario. So let's start with the receivable level of original. First step, we have to find out the original average account receivable. The data was telling us that we have $5 million of sales, and originally we had 6 account receivable turnover. So therefore, on average on the balance sheet of the company, there are $833,333 of account receivables. So after the introduction to the new policy or the discount approach, we have to calculate the receivable level of with the new discounting approach. The only data change is actually the number of account receivable turns, because 30% of the customer were availing the discount period, so therefore the account receivable turns has been increased. So the new level of account receivable will be $555,556. So we can see that when the company introduced discount, 30% of the customer paid out within 10 days, and this early payment are expediting the process of account receivable collection is actually resulting in the reduction of average level of account receivable available on the balance sheet. So if we try to find out the difference between the original level of account receivable and after the introduction of new policy or change or a discount offer, we can infer that we have actually reduced the level of investment in our account receivable by $277,777 if we subtract the new account receivable level from the previous account receivable we can see that we have actually saved our $277,777 of investment in the account receivables. So move ahead. And as we know that 30% of the customers are paying within 10 days, so they have to be given with 2% discount. So first of all, divide, in order to remove the percentage sign with 30%, we have to divide it with 100. This percentage sign will removed, and ultimately this expression will be transformed into 0.3. You have to multiply it with the total level of sales. It will give you a certain number of discounted credit customers, and then these customer, which is 30% of the total sale, will be offered with 2% discount. Therefore, the overall discount paid by the company will be $30,000. So in this case, actually this pre-tax cost of cash discount is the cost to the company. By introducing this new credit or cash discount policy, the company is going to bear $30,000 in cost against the discount offered to those 30% customers. The final step is to find out the pre-tax opportunity saving on the reduction in the account receivable. As we can see that in the previous step, we have reduced our level of investment in the account receivable. So this amount can be utilized in investment somewhere else in option B, which is actually the opportunity to the company. So therefore, we are going to invest this amount if we are offering this opportunity or discount to the customer. We are going to save our additional investment of 277,000 approximately in the account receivables. So therefore, this amount could be invested in somewhere else, which is actually providing us 20% return. So this is actually the pre-tax opportunity saving on the reduction in the account receivable, and this is our, if we multiply 20% with 277,777, our saving will come up with $55,555. So the final step is to take a decision. You have to compare the saving versus cost. So if we offer cash discount to the clients, our saving is 55,000. However, our cost is 30,000 against the discount we are offering. Hence, our saving is greater than cost. So therefore, the decision of the basket vendor will be yes to relax or to offer the cash discount to all credit customers in order to expedite the average collection period or to expedite the collection process of account receivable, and hence to efficiently manage their account receivable. So primarily, the financial manager is interested to collect its account receivable as soon as possible, until and unless the saving or the opportunity earning is greater than the cost the company is going to bear. So what is the benefit derived from release accounts receivable? It exceeds the cost of providing the discount to the customers, as already explained. Let us move ahead with our final alteration. Let me remove all this ink. Here we have an additional topic of seasonal dating. What is the meaning of seasonal dating? Sometimes in order to reduce the carrying cost and as well as wear and tear cost, some companies are offering seasonal dating to the prospective customers. And what is this? They allow credit terms that encourage the buyer of seasonal products to take delivery of those products from peak sales period and to defer the payments until the peak sales period over. For example, we can see that in summer we have the high level of sales for certain commodities like soft drinks. So in that case, the companies sometimes offer to buy their commodities. They offer to the prospective customers like retail businesses to buy the commodities before peak sale, and we know that the peak sale starts in summer and it will go on until the summer is going to end. This is actually the peak sale time period. On this point T, the companies offer them to purchase the commodities, that is to explain that to take delivery before peak sales, and after selling these products here at this point, which is T2 time 2, they actually require the purchaser or credit customer to pay out their obligation. So when certain companies are offering their product on such terms and condition, it is known as seasonal dating. And what is the benefit of this offering to the company? It actually avoids the carrying cost of the inventory, because if the supplier is keeping that inventory in their own warehouses, so it will have certain carrying cost involved over there. Beside this, accepting this seasonal dating, if warehousing cost, so what is the condition to accept the seasonal dating? The condition is when the warehousing cost plus the required return on investment in the inventory exceeds the required return on the additional account receivable. So when our warehousing cost with the company is greater in number than what we are going to earn on the, or what we are required to earn on the additional account receivable, so in that case our decision will be to go with the seasonal dating in order to avoid or to reduce the carrying cost and holding cost of that inventory in the company's warehouses. Let's move ahead with our final factor of credit and collection policies changes. Now we are at stage 4 to discuss the firm's collection programs. What if the company is going to alter its credit period or length of the time period required by the company, and different customers, credit customers, are required to pay out within that stated or stipulated time period. So we have to take an example of policy A and policy B under the context of present policy to understand what if the company is altering its collection program. Under this scenario, basically we will deal with the default risk or the bad debt losses. As we have earlierly explained in the diagram, we have to cater the factor of bad debt losses as well. So in the final factor, we will address what is the impact of bad debt losses if we are relaxing our credit period on the overall profitability of the company. So we have been given with a numerical data in a tabular form. In this case, we have our present policy, and according to the present policy of credit and collection under the account receivable management, the demand of the annual credit sale is 2.4 million. The default losses in the present policy case is 2%. It means that over these over 2.4 million dollars of sales, 2% of the customers usually do not pay, and this result in default losses, we can say. So when the credit customer is unable to pay out their obligation to the company, we usually say that they have been defaulted on their obligation. And the average collection period for present policy is 30 days or 1 month of time period. So this is basically our present policy, and the company is going to alter or change its present policy to policy A or to policy B. And pros and cons of this alteration should be in the form of numerical trade-off between profitability and the cost associated with such change. So in the policy A, we can see that the company is going to relax the credit period to the customers, and they are now requiring them to pay out their obligation in 2 months. So this will lead towards 10% on the incremental sales default losses. So when they are extending the time period, this policy A will lead towards $600,000 of incremental sales are additional sale, because now more and more credit applications would have been accepted because the time period is relaxed to the credit customers, which is 60 days now. So therefore the previous sale was 2.4 million, and the incremental sale because of this relaxation is now $600,000. So overall sale of the company under policy A will be $3 million. But there is certain default losses associated with incremental sale over here. That is, out of this $600,000 of incremental sale, 10% of the credit customer will default and will not pay out their obligation on due time. Similarly, in the policy B, we can see that the incremental sale is now $300,000 more than the policy A. Why? Because the company is going to further relax their collection periods to 3 months or 90 days. So in this case, the incremental sale is telling us that the data is telling us that we are going to lose 18% of this incremental sale if the company is going to opt for policy B. So the question is basically over here to evaluate the profitability and cost associated with policy A and then with policy B, and finally to conclude that which policy is more appropriate to the company. So let's do it. First of all, we have to address the policy A over here. And how did we calculate these numerical values? Let us discuss one by one in detail. The first condition was that when the policy A was adopted, we have been given with an additional sales of $600,000 and the profitability margin is 20% multiplied by this first factor, which is additional sale. So the profitability of this additional sale is actually 20%. So we have to multiply 20% with $600,000, as this one is representing this condition or statement number one's numerical value. So multiply 20% with $600,000, as the contribution margin was 20%, because if we divide 5 by 25, which was the sale price of the product, the contribution margin was 20%. So on each dollars of sale volume, we are earning actually 20% profit. So profitability in policy A will be $120,000. And now we have to compare our profitability with additional cost of funds tied up in the additional account receivable. So let me remove and go further. In step number 3, we have to calculate the additional bad debt losses. So we have to multiply the $600,000 with the bad debt losses percentage. Let's move back. The bad debt losses percentage in policy A is 10%. So if we multiply this 10% with the additional incremental sale, it will have $60,000. So as we have mentioned over here, in step number 4, additional receivable to be calculated, because we are relaxing our credit policy. So therefore we will have an additional account receivable. Let's go back and to find out the new account receivable turnover. As the company is collecting in 2 months, so therefore if we divide 12 months by 2, the account receivable turnover will be 6 times in a year. So we have to divide this incremental sale by 6 over here, which is new account receivable turns. The resultant value will be $100,000 is stuck in the additional account receivable. In step number 5, investment in the additional account receivable is 80%, because when the contribution margin was 20%, so the cost involved in each dollars of funds tied up in the account receivable will be 80%. So if we divide 80 by 100, we will come up with 0.80. So multiply this 80% with fourth value. And in our previous step number 4, our additional additional account receivable balance was $100,000. If we multiply it with 80% of additional funds tied up in the additional account receivable, the investment in additional account receivable come up with $80,000. This is actually our cost of what we have sold to the customer. In step number 6, we have to calculate the required before tax return on additional investment of 80,000. So if we multiply the step number 5, which is 80,000, with the required before tax return, and as we know that the opportunity cost or pre-tax return is 20%, as we are continuing the same example as we have done in the couple of previous lecture and in this lecture as well. So if you multiply 20% with 80,000, the required before tax return on additional account receivable is $16,000. So let's move ahead. Finally, in step number 7, we have to calculate the additional bad debt losses plus the additional required return. So additional required return is $16,000, and the additional bad debt losses because of the relaxation of the policy is $60,000. So in total, the company is going to have a cost of $70,000. After summing both these values, the resultant cost is, or additional bad debt losses plus additional required return, is $76,000. So the final step will be to compare the profitability with the additional return and to take your decision. So subtract profitability, or rather I must say the additional bad debt losses plus the required rate of return from the profitability under policy A. And as we can see that profitability is quite greater than the total cost bear by the company. So therefore, we can say that policy A is worthwhile. But hold on for a while, because we have to check out the policy B, which is that the company is going to relax its collection periods to the 3 months or 90 days. So the additional incremental sale was 30,000. The bad debt losses were 18% of this incremental sale, which is $300,000. The value is $60,000 is first of all, we have a profitability percentage to be calculated, which is 20% margin. So apply 20% on $300,000, and the profitability under policy B is 60,000 if we are going to further relax our account receivable. The bad debt losses are 54,000, as if we multiply 18% with $300,000 of incremental sale, 54,000 will be uncollectible because this is turned out into the bad debt losses. Once again, the additional receivable, we have to divide this first value with the new account receivable turnover, and as per the new account receivable turnover, there will be 3 months. So if we divide 12 by 3, we have 4 account receivable turnover. Therefore, we have to divide this $300,000 by 4, and we will come up with $75,000. Finally, we have to calculate in step number 5 the additional receivables in the because of this policy B are 60,000, as we have already calculated in the policy A. So therefore, I am quickly going. The required before tax return on the additional investment is to multiply the fifth step value with 20% opportunity cost, and it is $12,000. This is our required before tax return on additional investment tied up in these account receivable, because we are going to relax our policy further. The 7th step is to sum up the additional bad debt losses plus the additional required return. So we have to add up 12,000 and as well as the bad debt losses of 54,000. If we sum up both the values, we have our total cost of this policy this policy B, if we are further relaxing our collection towards 3 months. So the final step will be once again to compare the overall cost of policy change with overall profitability, and we can see that 60,000 profitability is quite less than the 66,000. Therefore, this policy will lead towards a negative incremental profitability, or we can say net loss of $6,000. Therefore, when the profitability or incremental gain is negative, we have to reject that policy, and until and unless certain policy is having positive impact on the overall firm's profitability, that policy shall be selected. So the final decision is to adopt policy A but to reject the policy B. So in this fashion, our account receivable will be managed in the efficient way. So this was all about the four factors of quality of trade accounts. Length of credit period is discussed in the couple of previous lectures, and in this lecture we have addressed the possible cash discount and its impact. And finally, if we change our credit collection policy, then we have to look at the bad debt losses to be catered and addressed. Along with that, we have to check the incremental profitability and the cost associated with that policy change. And until and unless certain policy is contributing positively in the overall profitability of the firm, those policy will be selected. And if certain policy is having negative return or net loss, that policy will be rejected. And this is the way you can manage your account receivable efficiently while working as a financial manager. This was all about the details pertaining to the account receivable management. If you have any question, you are free to ask on KCMS, or otherwise you can email me with your queries on email address as mentioned in the footer of this lecture. Thank you very much. Good luck for the day. Allah Hafiz.